Hi, my name is Don Wenner, CEO and founder of DLP Real Estate Capital, and I'm joined by Jim Dolly, CEO at White Coat Investors. Thanks for jumping on here with me, Jim.
Thank you. It's great to be here, and I'm excited for this conversation.
Awesome. Well, Jim, I wanted to give an opportunity to share with you and your investor base a little bit about DLP, our investment funds, kind of what we do and how it works. And can't wait to jump in and do so.
Awesome.
So I'm going to grab a little visual aid for us here and dive in. All right. So DLP Real Estate Capital and our subsidiary DLP Capital Partners, which is our investment fund managers, we're located, as you see there, that picture on the screen is here at our St. Augustine, Florida headquarters, which is where I'm talking to you from here today. Also headquartered as well, our Northeast headquartered in Bethlehem, Pennsylvania, where I started the company about 15 years ago. And we're a family real estate company focused on delivering phenomenal returns, consistent distributions to our investors. I'm going to show you what we do and how we do that here. A little bit about myself. This is year 15 now of since I started DLP. Over that period of time, we've been fortunate to close more than 16,000 real estate transactions, have done over $1.5 billion in real estate lending. We've also acquired in the equity side over $1.5 billion as well. Today, we own with our investors a portfolio of more than 11,000 single-family, multifamily rental homes. We've won a lot of awards for the culture and organization we built and the growth we've been able to have, growing now every single year for these 14 plus years by 60%, 60% each and every year. And more important than all of that, to me, at least, I'm a father to two little boys you see on the left of the screen there, Donnie and Alex, who are 7 and 8 years old. My wonderful wife, Carla, we just celebrated our 10-year wedding anniversary and renewed our vows just a few weeks ago. And we reside, as I said before, here in St. Augustine, Florida, as our primary residence. DLP Real Estate Capital is the parent business that oversees all of the integrated family of businesses. But as you see there on the top of the screen, DLP Capital Partners is really our engine and what drives everything we do at DLP. The capital that our investors entrust to us to deploy into both making loans to real estate investors and through DLP lending, as well as through going out and acquiring, approving, and building residential rental communities and providing all of the management, construction, and asset management as well throughout that portfolio. We have a number of businesses from our loan servicing company, our title company that support our ability to execute on our investment strategies of investing in investment housing as an equity investor, as an operator, and as a lender. Today at DLP being now year 15, we've grown quite a bit from where we started, and proud to say that we passed the $1 billion in assets under management mark a few months ago. Actually, you're now at about $1.1 billion in AUM. We do over $100 million a year in revenue across our operating businesses. We have over 600 loans out to real estate investors as we speak, and own a portfolio directly with our investors of over 11,000 single-family, multifamily rentals. We're pleased to serve 1,100 investors who are invested in our funds, allowing us to provide housing to more than 25,000 residents, where we provide loans and capital and support to more than 200 real estate entrepreneurs. And DLP is an organization of just knocking on the door of 400 team members or employees across those businesses that I covered on the last slide. So I'll explain the couple strategies, and then Jim, I'll open it up for us to kind of talk a little bit more about this. Our equity side of our business is called the fund is called the DLP Housing Fund. This is our most recent fund. It's our 8th fund we've launched over this past decade. This is a $1 billion evergreen REIT. What we invest in is predominantly value-add multifamily. A lot of people would call it Class B multifamily is what we do, but more importantly is what I like to think about is we invest in affordable rentals, affordable communities, meaning that the rents are affordable to what the incomes are in the local market. To give you perspective, our average rent across our portfolio is about $850 a month. Those communities can be as new as 2019 to as old as 1960s. But what we focus on is being affordable, safe communities, providing great service and wow experiences to our residents throughout our portfolio, and investing in mainly secondary and tertiary markets that have good, solid job and population growth. We do that throughout the DLP Housing Fund, currently owning now over 6,000 apartments closing in on $400 million worth of communities. This fund will continue to grow. It's an evergreen REIT, so we're going to continue to operate and grow this fund as long as the strategy makes sense, likely growing this fund over the next couple of years to 15 to 20,000 apartments and rental units as we scale the fund and the platform and the management that supports that. This fund is evergreen and open-ended, but as investors, you're not committed to being in this fund long-term. You have the ability to redeem out of the fund each and every year. We have annual redemptions to go along with our annual valuations that we do of our entire real estate portfolio. Like most real estate investments, this fund is very tax efficient. You get all the benefits of depreciation, which in most cases will offset the majority, if not all, of the operating income. This fund is also, being a REIT, has unlimited qualified business income deduction, which reduces your marginal tax bracket on this investment by 20%. What makes this fund pretty unique, being that it's an open-ended evergreen fund, is that as we sell properties off, we're able to do 1031 like-kind exchanges and defer out those taxes. That gives investors the ability to essentially choose when you want to have a taxable event based on when you choose to redeem out of the fund, giving you flexibility to control your taxable event and giving us the flexibility to not be forced to be winding down the fund at what would be possibly a not opportune time for the fund or for any individual asset. This fund provides distributions each and every month out to investors, but has the option to allow those investments to compound and grow. The fund provides a 6% preferred return. That means 6% that investors earn before we earn anything. One of the things that I can promise you is unique, and if you look at any funds throughout this sector or probably almost any private fund that you'd invest into, is that our management fee that we earn, and this is the case in all of our funds, is subordinate to that preferred return, meaning we do not even earn a management fee until we achieve that preferred return, which is actually distributed out on a monthly basis if you choose, or again, you can allow that to be compounded if you so choose. After we achieve that preferred return, then we get our management fee, and then we have an 80-20 split with a target return of 12% net to investors, with the ability to redeem out in part or in whole each year. This is $1 billion fund that's it's finishing up its first year of growth, and has been growing, as mentioned before, pretty quickly. Now already owning over 6,000 apartments. One of the other things that's pretty unique, I think, about this fund is we really focus on having a great alignment of interest between ourselves and our investors, putting investors first in terms of the preferred returns and distributions before we earn anything, but also the fact that myself, our management team, are investing heavily right alongside our investors. In fact, we're required to invest at least 5% of all the capital, but today we have about 25% of the capital in this fund. So we're investing heavily right alongside our investors. We have a great accounting firm doing our audit work, Cohen Resnick, law firm Stewart and Kissel. We distribute monthly, have the option of taking distributions monthly, and we do quarterly reporting here in the DLP Housing Fund. So that's one side of what we do. That's the equity side. And then we do the majority of the management, property management, construction management, asset management throughout that portfolio as well. The other side of our business is our lending side of our business. We have two investment vehicles to talk about here in this conversation. One is the DLP Lending Fund, which is a $500 million evergreen REIT. This fund has been running now for over 6 years. Over those 6 years, we've generated over a 13% return net to investors. The fund has a targeted return of 10%. That targeted preferred return is paid out every single month. In fact, it's actually paid out on the first of each month. And then every month, once we close out our books for that month, we actually pay out a second distribution every month for all earnings above 10%. Actually paying out 2 distributions a month, paying out double-digit returns every single month, while giving investors the ability to compound and reinvest those distributions. This fund also is a REIT as well and gets the unlimited qualified business income deduction we talked about earlier as well. This fund has a very high, for most people's standards, preferred return, 10%. Again, investors earn 10% before we earn anything, even our management fee. So investors get their 10%, then we get our 1% management fee, and then we have an 80-20 split. We've exceeded that 10% preferred return every single month. In fact, we've exceeded our target returns in every one of our funds in every period here, including the DLP Lending Fund. This is an evergreen fund that, for a private fund, is very liquid. From the first day you invest, if you invested with us today and tomorrow you had a better opportunity and you wanted to redeem your entire investment, you could request that redemption and we'll redeem your investment out within 90 days. In fact, nobody has ever waited more than 54 days for full redemption of any redemption requests. So for a private fund, extremely liquid. So in summary, very liquid fund, providing double-digit returns with monthly reporting and monthly distributions. Here's our historical performance over this last 6 years of running this fund. 10% is this dark blue, 11% is this middle number, which we've been over 11% in every single period. You'll notice here in this slide that this shows our actual annualized return every single month since the fund has been launched. Let me go back there. And up until COVID, we had never fallen below a 12% annual return, meaning we had never had a single month where we distributed less than a 1% return net to investors. The returns have fallen still above our target to a little over 11% since COVID. And really, the returns have come down because we're sitting on a lot more cash and using less debt or leverage. But we've had phenomenal performance throughout our fund. In fact, now for 10 straight months now through COVID, we've had no defaults, not one single default. We've had no forbearance agreements. We've had phenomenal performance across all of our borrowers, even though we have borrowers in some of the hardest hit states that completely shut down construction for a few months, such as Pennsylvania or New Jersey. So we've had really great performance. And I missed it earlier, but on our equity side of our business where we own our portfolio, we've had incredible performance through COVID as well. We've actually had broken all-time high occupancies throughout our portfolio every single month through COVID. We've lowered our cost of debt, and we've actually grown our cash flow every month since COVID, which is pretty incredible, all things considered. So the third vehicle we have is also invest, just like the lending fund, into making short-term private loans to real estate investors. So both the DLP Lending Fund and the Positive Note Fund make short-term loans to real estate investors. These aren't loans to homeowners. These are loans to full-time real estate investors. Average loan to value of 54%. Our average borrower has over a 700 credit score, over 3 million in net worth, over 500 grand in liquidity, have done more than 50 real estate deals. These are professional full-time borrowers. Our Positive Note Fund gives you an ability to be at an even lower LTV, even lower risk profile, and also lock in for a fixed return. So here you're actually lending money to the fund, getting a fixed return on your money. You can choose to invest for as short as 90 days, essentially an evergreen note that you can redeem out of at any time with 90-day notice, or commit for 1 year, 3 year, or 5 year, kind of like a CD, and lock in for a fixed yield, much different than today's CD fixed rates, anywhere from 5% to 10%. With options of taking distributions monthly or letting it compound and grow. So with that said, Jim, that's everything I have here in terms of slides here, and love to kind of turn it to you for questions and dive in further.
Sure. I mean, it's pretty exciting. A lot of the things you're pointing out there. For example, the fact that you don't take your fees until the preferred return's been paid. I've looked at a lot of these deals and I've never seen that before. It's pretty incredible.
We haven't seen it from any other funds yet either. And it's unique interest. We're really focused on making sure our investors get paid first, putting people first. Our funds, even though by most people's standards, not everybody, maybe most people's standards would say our returns are pretty attractive or pretty high. What we focus first and foremost is no losses and consistency in return. So by putting investors first, getting their returns before we get to turn anything, helps make sure we assure that consistency in our returns and distributions, putting investors first.
Now, I've been invested in the lending fund, at least through a third-party access fund for a couple of years now, and been pretty happy with the returns there. But a lot of my readers might not understand why somebody would come to you to borrow money for their real estate investments. Can you explain why people come to you to borrow money?
Yeah, I'd love to. So again, just to give a little color, we're lending money to, as I described, these professional full-time investors. And to give a little more specificity, we're lending to investors who are flipping homes. We're lending to investors who are building single-family rental portfolios, landlords. We're lending to single-family home builders. We're lending to multifamily operators. And I'll also mention, I covered, of course, a lot pretty quickly, but every one of those types of strategies we do at DLP and have done, pretty significantly, have a lot of knowledge and experience in these asset classes. So we're lending to these investors who are running companies kind of similar to DLP, generally smaller, but people who are doing this on a full-time basis, who are or going out there acquiring properties, managing them, doing the construction, doing the property management, et cetera. These are professional operators. Again, most of them are, the vast majority, if not all of them, are bankable. Again, 700 plus credit scores, cash in the bank, strong financials, no bankruptcies, foreclosures. I mean, they're strong bankable investors. So why they come to us is a few reasons. First and foremost, I'll say is speed. And the best way I'd like to describe that. So if I went to one of my banks that we work with, that I work with I have deposit and banking relationship with, and I came and said, all right, I'm going to buy this property. Hey, Mr. Banker, I'm buying this property for $1 million. Okay. And I want to put down 900,000 of cash. So Mr. Banker, I just want you to give me $100,000 loan against this $1 million property. And oh, by the way, I have $1 million on deposit with the bank as well. In that scenario, which would of course be a no-brainer loan for a bank to give, right? They still couldn't get that loan done in 30 days, right? Our borrowers are coming to us needing to close these loans generally in 15, 20 days. They need speed. So that's first. Second is, which goes right along with it, is they need surety of execution. So they don't want to have any question. Again, banks don't understand how operators work. For them, they'll come to you and say, oh, I know you have to close next week, but we didn't have committee this week because so-and-so was on vacation. So I won't be able to close your loan this week. Hopefully we'll get it in front of committee next month, right? They don't. What's a bigger deal to them than what they pay in interest rate is the risk of losing the deal. Our average borrower on the deal they make, they're earning about a 40% return on their capital. They're earning about a 22, 23% return on the whole deal. And they don't want to lose that deal. That's a lot more important to them than the interest rate. Because keep in mind, our loans are 6 to 12 month short-term bridge loans. So the difference of paying a 10% interest rate, which is what we charge, versus even if the bank was an option at 4%, that 6% interest rate difference on a $150,000 loan for 6 months is a couple $1,000s. So that couple $1,000s is worth the speed, the ease, the surety we're going to close. And then the other big things we focus on is delivering wow, making it really easy. Nobody likes their credit pooled. Nobody likes giving their tax returns. Nobody likes giving their bank statements. All things we require, just like a bank do. We try to make it as enjoyable as possible. And the last thing that we do that I think is pretty unique and pretty different of why people are willing to pay our rates, which on average about 10.2% is the interest rate. It's actually more than that, which I can describe, is that we really focus and spend a lot of time and energy and effort helping these operators, these borrowers, build and scale their businesses. So I just wrote a book here recently called Building an Elite Organization. And it's a book on how we run DLP. It's called on our operating system. We call the Elite Execution System. And this operating system is how we run DLP in a very disciplined manner, how we've grown by 60% or more every year. We built this system, wrote the book on it, have a technology on it, et cetera. And we help these operators implement this discipline to how they run their meetings, how they hire, how they develop leadership, et cetera. We help them run that, put that into their business, and also help them, from a construction management, asset management, brokerage standpoint. We give them kind of access to DLP and our knowledge and resources and tools and systems. So they really look at us in many ways as a partner, as somebody they can really count on. So they're willing to pay a little bit of a premium to have access and have us as a relationship helping them, grow and scale their business.
Let's talk a little bit about the risk in a lending fund like this. I mean, obviously, this isn't buying a 2% treasury from the government or buying a 1% CD from a bank. What happens in the event that there's a default? One of these developers, for whatever reason, decides, this isn't working out. I'm defaulting on the loan. Can you explain the process that happens at that point?
Well, yeah, I love to, Jim. So first, as I mentioned before, I'll mention, 10 months now, not a single default. And we define a default as 60 days behind on their payments, but we actually haven't even had a 30-day delinquency since COVID. But of course, in our 6+ years of doing this, we have had defaults. We have had borrowers who get tight on cash and can't make a payment. And that's generally what happens. So keep in mind, a lot of these guys and gals are doing this full time. And so what can happen is they, renovated a couple houses and they were scheduled to close, and they're going to walk away with $100,000 or $200,000 on that sale, and the deals get delayed. Buyer couldn't get their mortgage and it falls through, and they get tight on cash. And that's the typical thing we've had defaults happen. They're just tight on cash. They can't make payments for a month or so. Then they have a home sell or a refinance happen, and now they have a bunch of cash and they get current. That's what happens, 95% of the time that there's a default. But in the times that doesn't happen and they, get overextended, really get themselves into a situation, which, unfortunately we haven't had happen in a long time. But when that does happen, we work aggressively with them to try to work on a solution. We've had cases where we've been able to help them, flip that deal over to another investor. We've had times we've been able to help them bring another operator investor into the deal and partner with them and bring them capital. We've had times we've helped them just get the property onto the market and sell it quickly, even in as-is conditions. So we've done a lot of creative things to work with them. But if they say we get a borrower, we've had this happen a few times, they don't cooperate with us, they're not responsive, they won't take our help, and we have to go and take the legal route, we're able and willing to do that. We employ a full-time attorney who his job is dealing with loan servicing, sending out notice of defaults, working on these types of issues. Actually, a gentleman who runs, we have multiple attorneys on staff, but Jeff, who's in this role, actually worked for one of the largest banks in the country, running their default department for 10 years. So have deep level of expertise in-house. And so we'll take the legal route and we'll file, a judgment, and we'll take action and go through the legal system. We have had loans, in the scheme of things, a very tiny number of loans, out of the couple thousand loans we've done, that have gotten all to the point that we had to do a deed in lieu of foreclosure, where they voluntarily turned us the keys over, or actually gone all the way to sheriff's sale. That's happened a very small number of times. It's been a while. And when those cases happen, what we actually do here at DLP is, if we get a loan that's getting close to the point that we think we're going to have to own the real estate, what we actually do is we actually buy that property, or that loan, I should say, from the fund. And when we say we, I mean I, in that I buy that loan from the fund for the total amount of the outstanding principal balance, plus any interest the borrower hasn't paid. So the fund doesn't write off $1 of interest or principal. And then I finish that work out myself. And when we do that, we disclose it to all investors. We denote it in our monthly reporting, that we bought that loan. And I always joke with investors and say, well, what if you make some money on that loan? What about the investor? I always tell people, if anybody else wants to buy that default loan, they can have it. But I always step in and do it because I feel it's my job. And it also helps us keep the financials clean and easy and simple. But we make it clear, we work those loans out over the few number of times we've had to do that. We end up in most cases breaking even. We made a few bucks, we've lost a few bucks, and literally when we say a few bucks, we're talking a few $1,000 one way or the other is the biggest extreme we've had. And the reason we haven't suffered any major losses is because we're lending an average 54% loan to value. So even if it took us a while to foreclose, we still have so much cushion that it's very rare that we run into any situation where we're anywhere close to being upside down on a loan.
Okay. Let's talk a little bit about the opportunity the white coat investors have to come and invest through DLP. They have a opportunity to invest in any of the three funds.
Yes.
And you've lowered the minimums for them compared to what you normally offer to individual investors. Can you tell us about that?
Yeah, I'd love to. Thank you, Jim. So yeah, actually, our fund limits have, and I think right now, for if you went on our website or you came to us directly, the actual housing fund on this slide, it says 250, but I think our minimum is now 500,000 in the housing fund. Lending fund is 250. So if you were coming to us directly, and that would be the minimum, and we hold to those minimums. It's a lot of time and energy and effort that we put into, every investor who comes aboard with us. I mean, we do a lot of, monthly reporting. We provide you with access to an entire investor portal. We do a lot of education and webinars and events, and just spend a lot of time with each relationship. And we've decided, in order for us to maximize our resources, we had to set these minimums, and we've steadily been growing them. But we look at the white coat investor kind of family as kind of one. And Jim and I and DLP have reached a arrangement, I guess I'll call it, to lower our minimum to $100,000 for anybody who comes to us through white coat. Making it a lot easier for investors to sort of dip their toe in, get to know us, get exposure to one of our funds, and determine if this is a place you want to continue to grow and allocate capital to over the course of time if we do a great job for you.
Awesome. That sounds pretty appealing. I certainly plan to invest some more money with DLP. How would someone decide if they're not sure if they want to invest on the equity side or the lending side? I mean, the returns are not that dissimilar. What advice would you give to someone that can't decide which way to invest? They've only got 100,000 to dedicate, and they're trying to decide what to do.
Yeah, that's a great question. I mean, so I'd say is, first thing we really try to do, and we're not, of course, we're fund managers here. We're not fiduciary wealth managers per se, or independent financial advisors, but we do try to take a consultative approach and work with you and say, all right, what are your goals? What are you trying to accomplish? And help you look at the situation and compare it. So I'll give a couple, kind of examples of, if you're coming to us investing qualified money, money in a 401k or an IRA, it can make it a lot, I guess you say, make the decision harder in a way, in that it takes away the tax benefits per se of the housing fund that make these funds more comparable in terms of the yields, which I'll explain further what I mean there. And so for qualified money, a lot of people choose the lending side of our business over the equity side, because the tax efficiency and benefit of the housing side isn't important anymore. I also want to look at, are you going to need liquidity? Is this money you're going to want to park with us, but you might want to access that money in a month or 2 months or pretty quickly? That could dictate which fund. Both funds are liquid. The housing side of our business is annual liquidity. Lending fund is, 90-day technically, but even faster liquidity than that. Also would ask, what kind of investment horizon are you looking at? Is this something that you're looking at being in long term? Are you looking at how important are monthly distributions? Both funds produce monthly distributions. The lending fund has a higher monthly distribution amount versus the housing fund, which pays out monthly distributions, but has a bigger, back end side that's paid out on an annual basis. So those are all factors I consider. So a lot of times it comes on investors, if they're looking at it as a longer term investment, and they want to maximize the return of their investment, they're going to choose the housing fund, because even if it's qualified money, the housing fund could very likely end up generating 14, 15, 16, 17, 18% returns. In our previous equity funds, we've hit over 20% returns. The lending fund, we're not going to shock you, and you're going to all of a sudden start getting 15%. It's going to generate consistent returns, as we showed in that slide. At this point, 11, 12% returns. Housing fund, if the market does well, which we're not modeling it to do particularly well, to be frank, in how we model our investments, the returns could be even higher than the 12% target. And then if you're not investing qualified money, meaning you care about tax, the tax effect of being in the housing fund versus the lending fund, having all of your income sheltered, or most of it sheltered through depreciation, while having the ability for us to sell assets and do 1031 exchanges, that compounded return of the tax saving over time is pretty tremendous of a difference. And if we modeled it out for you, and we would do this for you on your investment over 3 years or 5 years or 10 years, the amount you have at the end with the tax effectiveness in the housing fund could end up being a 4 or 5% effective higher annual return you earn over a longer period of time.
And what kind of person would the notes fund be appropriate for?
So I'll say, on the note side of our business, a couple of reasons people choose the note side. Number one, if you look at everything we say and you just say, look, I want to be in the absolute, lowest risk position. I like what you guys are doing. I want to get to know you guys, but I want to be in the lowest risk position as I dip my toe in. This could be, a great place to go. The other reason people historically have chosen the note fund is because it is our only fund that, other than white coat investors, we take in less than 250 grand. So some people will choose this fund because they don't want to invest more than 100,000, and they want to dip a toast. For you guys listening here, you have that flexibility of going to any of the funds at 100,000. The other thing is these returns are fixed. So there's a power and a benefit to knowing exactly how much you're going to earn. I have a 7 and 8 year old, as you saw earlier, and my 8-year-old could figure out, maybe not my 7-year-old, my 8-year-old could figure out how much money, he would have in a year or 3 years or 5 years invested here, because it's very simple. There's no fees that come out of this. These are the net returns to you. So you can easily go and see, if I take monthly distributions, exactly how much I'm going to earn every month. If I let it compound and reinvest, exactly how much money I'm going to have in a year or 3 years. And there's a powerful feeling knowing that, especially in these volatile times. So a lot of people really like that surety of knowing what the returns are going to be. And then so some people come in here and kind of dip their toes in. Some people at the end of the day, depending on how much they invest, say, hey, the returns are close enough to be in the lowest risk position, get fixed returns. I want to stay there long term. Some will come in and a note investor, and then after getting to know us, watching our reporting, meeting us, building a relationship, getting comfortable, then they'll convert over from a note investment into one of our, either the housing fund or the lending fund with time. And we welcome that.
Awesome. I appreciate you sharing that. I think more information is going to be available both on the White Coat Investor website, obviously on the DLP website, lots of information available. And if they have further questions for you, who's the best person to contact and how should they do it?
Yeah, thanks, Jim. And so, yeah, there's a couple things you can do here. Certainly, you can see here dlpinvest.com. So in addition to going to White Coat, you can go there and you can actually, within 20 seconds or so, create an account, and you can get access to all of our audits, our balance sheets, our income statements, our loan statements, our see the properties we own, as much information as you could want to see. You can do that all from the comfort of your home without talking to anybody. And then whenever you're ready, whether it's today or in the future, you want to talk with one of our leaders, I welcome you to reach out to any of the handsome gentlemen on the screen, Rich, Larry, or Bo, and they'd be glad to chat with you. Their direct numbers are there, as well as their email addresses, and they'd be happy to chat with you, explain more about what we do, explain in context of your goals, and determine if we're a fit for each other.
Awesome. Well, I appreciate your time today, and thanks for what you do for investors.
Thank you, Jim. Appreciate the opportunity.